Hello and welcome to yet another episode of Asian Tigers. My guest today is a veteran investor in the Indian markets, Krishna Kumar, portfolio manager at Eastspring Investments. Krishna, good to talk to you again. After such a strong start to the year, almost everybody's watching earnings very carefully now. The earnings season has just started. Do you think we'll get glimpses of the turnaround that we've all been looking for the last couple of years in this earnings season?
Yeah, I think we're coming on the back of a demonetization quarter, which was the third quarter of December of 2016. So there is a base effect which will kind of show quarter on quarter sharp improvement. I'm not sure how sharp is a sharp, but reality is that there will be a marginal improvement. Is that decisive enough to conclude that the entire economy is turning around and we are back on the growth path? Well, I will hesitate to kind of say that it is possibly not. We are going to see some recovery. There are improvements in the margin. Quarter on quarter, we will look better, but the consensus numbers are likely to be missed.
Is that a worry, Krishna? Because, this hope trade we've played for the last couple of years, people keep saying this is the year of the turnaround, and then in the middle of the year, the hope sort of fizzles out. Are you more confident this year that in the next 3-4 quarters we'll see a decisive turnaround, or are the metrics that you monitor not giving you that conviction quite yet?
So, there are a number of things that we're watching. One, obviously, is the way the GDP trending. Second is the overall matrices that kind of add up to become the GDP, which is maybe cement, maybe power, maybe multiple other factors which are kind of pointing towards the GDP number. All in all, in summary, it looks like it is going to be a recovery, but it's a very gradual recovery. It is not a sharp rebound. How much do we rebound? It's a question that we will have to wait and watch. But the important elements to the story is that there is an improvement on the margin, and the improvements are gradual. We would like it to be much quicker because these are known facts. These have been lingering issues for a very long time. Having said that, you must realize that the market expectation of a sharp rebound and a quick recovery is obviously going to be belied. The important point here is the numbers have not been reset for FY18, and the multiples obviously telling you that there is a sharp recovery coming through in 18. In FY18, there are a couple of episodes, stroke changes that would happen, and that can be a bit of a botheration. Will be GST obviously. And we just hope that GST does not kind of, make things look very difficult for the economy to kind of recover. Overall, I feel that, the path of recovery is going to be very gradual, and there are a lot of housekeeping initiatives that need to be completed before we kind of get back on the growth path.
But how much of it is already in the price, Krishna? I mean, if you look at how much valuations have expanded since the start of the year, do you think the market's already taken a march on or a leap towards pricing in a fair degree of recovery already? I'm not talking about just the index, but a whole host of universe of mid-cap stocks where valuations seem to have expanded significantly, pricing in not a gradual but fairly speedy recovery.
Yeah, absolutely. I completely agree with you. I mean, the mid-cap space is in a bubble zone, and people are, buying as if things are going out of fashion, and it looks like almost worrying to an extent. The large caps have remained more moderate, more sober, more tempered. But the fact is the mid-cap space is also a function of liquidity and function of hope and optimism that the mid-cap have got higher beta to play out. And they are running way ahead of expectation. On the large cap side, it's more sober because earnings are more predictable, earnings are more visible. But I'm not sure whether the mid-cap recovery can happen without a large cap recovery, which is more a function of economy recovering. And, I'm a bit worried about, the way P multiples have expanded, and the market is pricing in a very sharp recovery, if not in 18, at least in 19. But I just hope that, things are not, as bad, or maybe they just recover as we progress. But, I remain very concerned that the mid-cap valuations are completely out of range.
If there is to be disappointment, Krishna, because global markets have all done very well, I mean, where do you see that disappointment coming in from? Do you think it will be something which is not very predictable, like the geopolitical news which is coming over the last few days, which is not great and has the market a bit on edge? Or do you think a disappointment is likely to be more linked to, say, earnings or macro data, which is more fundamental to the market?
It could be anything which could be as flimsy as earnings miss, because the earnings miss is basically something that people are not factoring in. If there could be earnings miss, there could be a sharp correction. If there could be a rise in rates in the developed markets, which is already obvious now, will also result in a fair bit of correction. Reasons will follow, but the fact is that the yield gap which we saw, which is basically the real rates which have been playing out, have clearly played out. And I'm also mindful of the fact that the central bank has guided very clearly that the easing cycle is complete, and they will not want, they're more hawkish than they were before. They've reached the neutral rate, and from here possibly I don't see too much downside. So the rate cycle is clearly done. And next step to kind of think about is how solid is the recovery in terms of domestic consumption. I think if that falters, we might see that there could be sharp disappointment.
How do you see monetary policy domestically and its impact on equities this year?
Rates are wherever they are. I don't see rate environment kind of being volatile, but they'll be more benign. And so downside is if there is a rate spike, what happens? That's the key thing to look out for. And you will at some stage see that the real rates actually moderate, which will mean that either inflation rises or India will have to take that corrective measure between the gap between the developed market and emerging market real rates.